Portfolio theory represents the collection of several investments, including shares, bonds, energy, or other similar securities. That's what portfolio is all about. Let me explain. Say, for example, you have basket of investments. In that basket, you have shares, you have bonds, you have exchange traded fund, you have mutual funds, you also have investment in energy, you have investment in energy, you have commodity, you have real estate. So all of these are the investments you have in a basket. All right. So all these investments are what is called portfolio, the collection of several investments, okay, including shares, bonds, and other similar security are what is known as a portfolio. So there is difference between portfolio as well as a portfolio theory, a portfolio management. Portfolio management represents the act of building, okay, the act of building and managing several investment instruments that is consistent with the long-term financial goals and risk tolerance of an investor. That is what uh, portfolio management is all about. Portfolio management, like I said, is the art of building, all right? The art of building and managing several investment instruments that is consistent with the long-term financial goals and risk tolerance of an investor. That is what um, portfolio management is all about. What that simply means is that before you, as a portfolio manager, before you commit your clients' uh, funds into any investment opportunity, you need to understand the financial goals of the individual. Not only that, every individual has different or differing risk appetites. So the level of risk that you can accept may be different from the level of risk that I can undertake. And that's why it is important. You, as a portfolio manager, you must understand the financial goals that the individual investor want to achieve, as well as the risk appetite of such rational investor. Now, the modern portfolio theory is a theory that is based on how a risk-averse investor can construct portfolio to maximize expected return at a given level of risk, okay? And then, of course, the theory stipulates that investor should not only hold portfolio, but should also consider how individual securities in the portfolio relate to one another. That is correlation coefficient, which measures the relationship between securities in the portfolio. Now, according to modern portfolio theory, is a theory that is based on the assumption that investors are rational. Investors are rational and do not like risk, which means that given an investor a high level of risk, the same investor will expect a high level of return. And of course, where two or more securities or where two securities have the same level of return, the investor will select the one with a lower risk. Okay, let's demonstrate this on the efficient frontier graph. Okay, in efficient frontier, let me see. Okay, this is let me see. efficient frontier, the vertical axis, and then the horizontal axis. Here is the return. Here is the risk as measured by standard deviation. All right. Starting from 0.0. Okay, don't mind my graph. Okay. Let's say that's level 1, level 2. This is return level 1, return level 2. Then we have a risk level 1. Let me adjust this one. Okay. Risk as measured by standard deviation. So let's say this is risk level 2. All right. So you are going to plot the risk against the return. So let's say this guy will go like this. This guy will also go like this. All right. So this guy will join from here. This will also join from there. Then let's say this is, we have, there's a line that will pass through the graph from the origin. Origin is from 0.0. So that line that passed through the origin is what is called efficient frontier. Okay. So at the point of intersection, let's say this is a point A. Let's say this is point B. And let's say this is point C. Okay. So you need to, examiner can ask you to explain the theory of the modern portfolio theory. So when you're asked to explain the modern portfolio theory, all what I've been saying since are what you are supposed to say. Then you now draw your graph, then you explain the graph. Because it's not sufficient for you to just draw your graph without explaining it. You have to. Let me remove the bracket to make it clearer. Okay. This is point B. Remove this one too. That's point C. That's point A. All right then. So let's explain the graph. From the graph above, security A and C lies on, let me see if I can write it out. Okay, let me start from here. From the graph above, just to explain the graph, in case you are asked to explain modern portfolio theory, okay? From the graph above, or should I even use working notes so that, okay, let's continue. From the graph above, number 1, securities A and C. Security A and C have the same level of return R1, have the same level of okay. Let me redo that for us to. All right. In fact, let me use so that I can explain properly. Let me use a working notes to do this. I will stop sharing this. I will come back to this one later. All right. So that I can That is, let me see. Okay, this is better. I believe you can see my screen, please.
Yes, sir.
Okay, then. So let me redraw the graph. Here is return. Level 1, level 2, R1, R2, D1, D2. Here is the risk as measured by standard deviation, starting from the origin. Okay, so you plot return against the risk. Okay. Right. Let me see. So that represents efficient frontier. All right. So let's call this point A, this point B, here, point C. So you need to explain the graph. You then say from the graph above, number 1, securities A and C have the same level of return R1, but different level of risk, different level of risk, D1 and D2. So when you look at the graph, you will notice that security A and C lies on the same level of return R1 here, but with different level of risk, D1 and D2. Therefore, you as a rational investor, since the two of them have the same level of return, certainly you are going to select the one with a lower risk. And that is what I was trying to explain the other time, that modern portfolio theory is a theory that is based on the assumption that a rational investor do not like risk. Rational investors do not like risk. That is, given an investor a high level of risk, it will expect it will expect the same level of return. And where two or more security have the same level of return, we select the one with a lower risk. You will see that securities A and B have the same level of return R1, but security A has a lower risk as compared to security C. Therefore, security A is preferred over security C. So number 2, security A. Security A with a lower risk, with a lower risk. is preferred over security C. Okay, so I'm done with that. Then you will notice that security B and C fall on the same level of risk D2, but different level of return R1 and R2. So you also need to explain that. You then say, number 3, securities B and security C and B, or B and C, have the same level of risk D1, but different level of return R1 and
Size D2 is D2.
D2. Oh, sorry. Thank you, Gary. Yes, it's D2. Thank you. That means that shows you are following. Thanks. Okay. Therefore, security B with a higher return, since the two of them has the same level of risk D2, so security B with a higher return is preferred over security C. Okay, so let's put it down. Number 4, security C, security B with a higher level of return R2 is preferred over security C. Okay. Then number 5, you have selected security A and B over security B. So you need to explain. Now, security A and B lies on the efficient frontier. So you need to put that down. Securities A and B lie, let me write it, lie on the efficient frontier and are preferred over security C. Okay. Number 6, where a security is preferred over another security, over another security. The preferred security is said to possess a stochastic, is said to possess a stochastic dominance over the other security. So what this simply means is that security A and B since security A and B are preferred over security C, of course, that means both security dominates security C. And because they fall on the efficient frontier line, then they possess its stochastic dominance. Now, the choice is between security A and B. The choice,
Hello, sir.
yes.
Please, can you explain this stochastic dominance and this efficient frontier? What does it mean?
What means?
Stochastic dominance and efficient frontier.
I just explained it to you what it means now. I said that where two or more security are preferred over the other, they said to possess stochastic dominance. It's just a statistic. It's just a terminology. All right. But in any case, I will get back to you on that. I can uh, give you additional explanation, but let's move on. All right. Now, the choice between security A and B, the choice is now between securities A and B, because security A and B are preferred over security C. So, number 8, you know that security A and B are good to go. They are the two security that are preferred over security C. So, the choice between A and B will depend on the characteristics, risk tolerance, and the nature of the rational investor. All right. So let me just put it down. The choice is now between security A and B. Okay, let me just continue that. Depending on the nature, nature and characteristics. Okay, depending on the nature, characteristics, and the risk tolerance of the rational investor. Let me write it. Rational investor. All right. So number 8. Now, the one that has a lower return with a lower risk will be preferred by a risk-averse investor. The one with a higher return and a higher risk will be preferred, will be selected by a risk-aggressive investor. That's all. Security A risk-averse investor, a risk-averse investor will select security A. Why? A risk-aggressive investor will choose security B with a higher return and higher risk. So that's it. This is how, so in case you are asked to explain modern portfolio theory, this is what you are supposed to do. After explaining what portfolio is all about, the modern portfolio theory, then you need to explain by using the graph to demonstrate your points. Okay? So that's basically that. Now let's move on from here. I will stop sharing this. If you have any question on this before I switch, let me know. Pascal is asking, the slide is not on portfolio theory. Pascal, what do you mean by that? Pascal, you said the slide is not on portfolio theory. Talk to me. Pascal, are you still there? Okay, I want to believe you are fine. Let's move on. Okay, so let's continue. Yes. So that explains modern portfolio theory. So the next thing we want to discuss is risk return trade-off. About, I can't remember clearly, about 2 or 3 years ago or thereabouts, examiner asked you to explain risk return trade-off, 3 marks. So the risk return trade-off is just the positive relationship that exists between the expected return and then the systematic risk. Of course, a higher return is not possible in an efficient market. A higher return is not possible to attain in an efficient market over a long period of time without undertaking a higher level of risk. All right, you can't just you can't achieve a higher return without taking a higher risk. That principle, that concept still remain valid, that the higher the return, the higher the risk. If you cannot take risk, then you cannot achieve a higher return. That's just it. Okay. However, expected return should be greater for asset with a greater risk, which still corroborates the concept. Now, that's before we go to portfolio diversification, let's talk about portfolio risk. Let's talk about portfolio risk. A risk is a chance that an investment return will be different from the anticipated return. You know, when you want to invest, you will have your own expected return, what you intend to achieve, maybe 20% return on your investment, maybe 10% or 15% or 30%, whatever the rate of return that you want to earn on your investment. So you already have your anticipated return. Of course, the actual may be different from what you expected to achieve. That is a risk. So provided your actual return is different from your expected return, it's a risk. Portfolio risk is also the possibility of losing some or all the original investments. Okay, it's a risk. You will recall what happened in 2008 during the economic meltdown. Most investors lost money when the market crashed as a result of that. All right. Some even borrowed money for that investment and everything just went away. That's a risk. Okay. So portfolio risk is measured by standard deviation. Okay. Portfolio risk is measured by standard deviation. What are the types of risk? There are basically 2 types of risk. We have systematic risk. We also have unsystematic risk. The systematic risk is also known as beta, non-diversifiable, market imposed, all right, general, non-avoidable risk, all right, is a kind of risk that investor will like to pay in order to avoid, because, of course, it is not diversifiable, and as a result of that, it affects all companies in the economy. Any risk that will affect everybody, all the businesses in the economy, is what is known as systematic risk. You remember COVID-19, 2020 when the entire world was under lockdown. Businesses could not operate as they usually do. Of course, we now resort to new normal as a result of that. You can see that that pandemic affected everybody in the economy. So such risk is what is known as systematic risk. What are the causes of systematic risk? One is economic meltdown. When there is a recession, when an economy is experiencing a recession, everybody within the economy will suffer it. When there is a political turmoil, certainly, where there is where there is unrest, the business will also suffer. So that will affect everybody within the economy. Changes in interest rates is also one of the causes of systematic risk, because once interest rate changes, certainly it will affect price of goods in the market, because investors that have borrowed money at a higher interest rate, we need to push the burden to the final consumers, and that will also that will increase the price. So there's always relationship between interest rate and inflation. Of course, when there's inflation as well, inflation is also one of the causes of systematic risk. Okay, so when there's inflation, the purchasing power of money will fall, so everybody will be affected. Just we are experiencing since after the COVID-19, after 2020 till today, prices of goods and services are just increasing almost every week, and everybody is bearing the consequence. All right. So again, war. In a country where there is a war, there will be no peace. And where there is no peace, there will be no business. When there is no business, how do you want to make profit? So these are some of the examples of the events that can cause systematic risk. Okay, let's talk about unsystematic risk. The unsystematic risk is also known as non-diversifiable, specific, alpha, avoidable, non-market imposed, and also unique risk. Is a kind of risk that is peculiar to a particular company or industry within the economy. All right. Sometime last year, the Apex Bank, the CB Central Bank of Nigeria, rolled out a recapitalization exercise for the banking industry. So they recapitalized the banking, and which means that that particular change, that regulatory change, only affected the banking industry. Insurance and other industry within the economy are not affected, because that change is peculiar to the banking industry, banking sector. So that is what is known as unsystematic risk. Of course, examples of that include the causes of unsystematic risk include regulatory change, management change. All right, when there's management of change, there's a MOC, for example. You have a management team, and maybe due to one reason or the other, you have a change. Just like we are experiencing, currently we just have a management change in NNPC board. All right, the federal government just changed the reshuffle the NNPC board, so that could result to systematic risk. Okay. Then, of course, product recall. When there's a product recall, it will result to financial losses to the company that made the recall. some time ago, so about 4 years ago or thereabout, I can't remember clearly. There was a time that Samsung made a recall of one of its models. Samsung Galaxy, I can't remember the exact model. The phone was generating it, and then the company has to make a recall. And as a result of that, of course, you are spending money to produce that phone. Now you have to recall them back. So which means it's at a loss. Other companies in the industry like Apple, on other phone manufacturers, they are not affected. It is only Samsung that were affected because that particular recall was peculiar to Samsung. That is what is known as a unsystematic risk. All right. So that is just that. Now, like I mentioned earlier, standard deviation is used to measure portfolio risk. And the higher the standard deviation, the higher the risk of the portfolio. So later on, we are going to talk about how to calculate portfolio risk, how to measure portfolio risk, portfolio return, and the correlation coefficient. But before we go into that, let's talk about portfolio diversification briefly. Let's talk about portfolio diversification. Let me know if you have any question for me. Okay, so let's move on. Let's talk about portfolio diversification. What do you mean by portfolio diversification? Portfolio diversification is a risk management technique that combines a wide variety of investments within the portfolio. It is a strategy usually adopted by rational investors in order to minimize risk by mixing a variety of investments, including bonds, shares, energy, commodity, of course, which are unlikely to move in the same direction. All right. So what that means is that when you talk about diversification, say, for example, you have, let me see if I have a space. Yes. So say, for example, you have 100 million naira that you want to invest. Portfolio diversification is teaching you that, guy, don't put all this your 100 million naira on a particular or on a single investment. You need to spread it across such that if there's issue in one of your investments, at least there will be others for you to fall back on. That is what portfolio diversification is talking about. So out of this 100 million, you can invest, say, for example, 30% of the amount. You can invest like 30%. Okay. You can invest like 30% on shares. Okay. On shares, you can invest like 20% on bonds. You can invest like 10% on real estate. Okay. You can also invest like 5% on mutual fund. All right. You invest. Let's say, for example, let me make this one 15%. So you can also invest 25% in commodity. All right. So when you spread your investment across several portfolio like this, that is what is known as portfolio diversification. The fact that you have even spread, you have invested 30% on shares is not sufficient. You can also diversify this one further. Is the fact that you have allocated 20% on shares does not mean you are going to spend the entire 20% in a particular company. You have to buy shares in different companies, different industries, in communication industry, in education, all right, in insurance, okay, in the banking. So you spread across the shares that you want to buy in different industry. All right. So the essence of this is for you to have a well-diversified portfolio so that when there's gyration, when there's fluctuation in the markets, your investments will not be entirely be affected. So only the industry that are volatile is the one that that you may have a loss. But every other ones, you are good to go. That is essence of portfolio diversification. So it's teaching us not to put all our eggs in one basket. So you spread it across. That is the essence of portfolio diversification. All right. So that is for that. Now let's go back. Of course, there are forms or types of portfolio diversification. We have horizontal, concentric, and as well as a conglomerate diversification. You can just go through it. And finally, under diversification, how do you reduce portfolio risk through diversification? All right, this is an examinable area. Examiner can ask you how to minimize portfolio risk. So maintaining a diversified investment is essential to any long-term investment strategy for an investor. A diversification strategy can help achieve more consistent return over time and reduce the overall portfolio risk. Therefore, diversification makes a portfolio more resilient to gyration. Gyration means fluctuations, all right, in financial markets. However, to reduce or to minimize portfolio risk, a rational investor must invest in securities or assets that are negatively correlated. Not only that, an investor or a rational investor should also balance share investments across different industry, including financial industry like banks, insurance. You can also have investment in telecommunication, energy, technology. All right. So by spreading securities in the portfolio across several industries, investor can balance the normal swing that these sectors may experience and their impact on the portfolio may be minimized. So that is for that. So whenever examiner is asking you to explain or to discuss how to minimize portfolio risk, simply say, to minimize portfolio risk, investor must invest in securities that are negatively correlated. Not only that, investor must aim at geographical spread or international diversification. When you talk about geographical diversification, instead of you to concentrate all your investments in Lagos, for example, you can have some investment in Lagos, you have in the Port Harcourt, you have in Enugu, you have in Kaduna, you spread it across different regions so that when there's a trouble in a particular region, your investment in other regions will still be secured. So you will recall what happened sometime in 2020, was it 2013 or 2014 during the militancy in the South, when the militants were bombing the pipeline, okay? So you can imagine, and that's why you see most of all those IOCs, international oil companies, they have their head offices in Lagos. Even though the South people have been clamoring, they have been asking the IOCs that they should come and they should return their head office they should cite their head office in the South, but they refuse. It will be too much of a risk for them to undertake if they go ahead with that. All right. So during that period, the militants were bombing the pipelines. You can imagine if their head office is also in the South, what could have happened? All right. So, and that's why when you are investing, you must consider, if possible, you consider geographical diversification. Don't put all your eggs in a particular location. You can also embark on international diversification. You can have investment in Nigeria, go outside Nigeria as well, tap the opportunity, go to other Western African countries, go to Europe, all right? That's why you see some of our banks, especially the first-year banks, they have investment outside Nigeria. Some of them are even, some of them are on stock exchange in Europe, all right? So that's one of the best benefits of diversification. So that is for that. Let's move on to estimating portfolio risk, portfolio return, and the correlation for efficiency. Okay, it's not here. All right, let me just demonstrate that. Let me see. The formula is not here. Let me stop sharing this and quickly go into that. Okay. So the next we want to discuss is how to estimate portfolio risk, portfolio return, and the correlation coefficients. Estimating portfolio risk, return, and correlation coefficients. Okay. So how do you calculate portfolio risk? So let me show you the formula. Portfolio risk, denoted as DP. Now, whenever you are asked to compute portfolio risk, first thing first, you must know how to compute the risk of individual securities. Risk of individual security. Okay, let's say we have for a two assets portfolio. For a two asset portfolio, X and Y. When you say for a two asset portfolio, that is, you have just two securities in the portfolio. All right. So the risk of individual security is computed. For example, you want to compute the risk of security X. So you say D of X is computed as the square root of variance, which is summation P of X minus X bar square. So this is the formula for calculating the risk of individual security. Now, the risk of the portfolio risk, I will explain the letters later on. Portfolio risk. To calculate the portfolio risk, you can either use formula or you use tabular method. Whichever one you use, you are going to get the same answer. So the risk of the portfolio is computed as the proportion of the amount invested on security X, you square it, multiply by the variance of security X, plus the proportion of the amount invested on security Y, you square it, multiply by the variance of security Y, plus, because there are two, it's a two asset portfolio, then you plus 2. If it's a 3 asset portfolio, say for example, you have XYZ in the portfolio, then this one will be 3. Multiply by the proportion invested on security X multiplied by the standard deviation of security X, multiplied by proportion invested on security Y, multiplied by standard deviation of security Y. All of this multiplied by the correlation coefficients, okay, correlation coefficients between security X and Y. Okay, of course, you have to square it. All right, so that represents the formula for calculating the risk of the portfolio. Okay, let me explain the variables, or maybe I should just give return, then I will explain everything once and for all. So these are the two formulas that you can use to compute portfolio risk, or the risk of individual securities in the portfolio. Now for return, calculating return. Okay, calculating return. How do you compute return for individual security? All right. Return for individual security. Expected return of individual security. Okay. So to get the expected return of individual security, then of course, return of security X, which is X bar, will be computed as summation of probability of X. Just multiply probability with the return. So it will give you the expected return of individual security. Then the expected return of the portfolio. Expected return. Let me write that. Expected return of the portfolio, denoted as RP. The return of the portfolio can be calculated as the proportion of the amount invested on security X multiplied by expected return on security X plus the proportion of the amount invested on security Y multiplied by expected return on security Y. So you add the two together, then that will give you the return of the portfolio. Lastly, calculating correlation coefficients. Calculating correlation coefficients. All right. So the correlation coefficient denoted as R. Let me underline this. And this too. And let me see. Okay. Calculating risk. So this is A. So that's the difference. This is B. And this is C. All right. So the correlation coefficient is computed as covariance between security X and Y. If in the portfolio you are given the securities are represented with A and B, it will be A and B. If it is X and Y, then you have to use X and Y. All right. Then divided by the standard deviation of security X multiplied by standard deviation of security Y. So that is the formula for calculating the correlation coefficient. The correlation coefficient measures the relationship between securities in the portfolio. You recalled earlier when I was explaining the um, modern portfolio theory. I said that modern portfolio theory stipulates that investor should not only uh, should not only focus on the securities in the portfolio, they should also consider how they are related to one another. So that relationship between the security within the portfolio is measured by correlation coefficient. Okay, now to get your correlation coefficient, you also need to determine the covariance between the securities. How do you calculate covariance? Covariance is computed as summation of probability of x minus x bar multiplied by y minus y bar, y minus y bar. So that's the formula for calculating covariance between securities in the portfolio. So let's define the variables where we started with P, where P equal to probability. Okay. Then, of course, we have X. X is security X, or let me just say DX. We have DX, which is standard deviation of security X. Standard deviation of security X. Of course, you also have standard deviation of security Y. That's the DY. Standard deviation of security Y. Then we also have return X is return of security X. So that one is clear. Then WX. WX proportion. This is proportion of the amount invested on security X. All right. The same thing for Y. Then we also have X bar, RX bar, which is equal to expected return on security X. Okay, what else? Then R. I've already mentioned how to be correlation coefficient. Then covariance. Covariance of X and Y. Let me write that. X and Y. This is covariance. Covariance measures the linear relationship between two variables. Covariance between securities X and Y. All right. So that's that. This is how to calculate the risk return as well as the correlation coefficients between securities in the portfolio. Now, one thing you need to know for exam purpose, notes. Number one, when the probabilities, okay, let me rewrite that. When the probabilities of securities in the portfolio are different, it means there is no relationship. It means there is no relationship between the securities, between the securities. That is, R is equal to 0. So in the formula where you have R, in this place, when you are calculating the risk of the portfolio, this place where you have the R, this R you have here will be equal to 0. Since since the probability between the securities is equal to 0, I mean the probability of the two securities are different. In as much as the probabilities are different, it means that the correlation coefficient will be equal to 0 because there is no relationship. Number two, the return of the portfolio or the returns of the securities must be given in percentage, must be given in percentage if the return is in absolute value. Absolute value, it should be converted to percentage using the formula below. Okay. So whenever you are given the return of individual security, whenever you are given the return of the security in absolute value, you don't use absolute value, it has to be in percentage. So in this case, you need to convert it to percentage. Therefore, return in percentage will be computed as value, the Naira value given to you at the end, value at the end, minus value at the beginning, minus value at the beginning, over value at the beginning. Of course, everything must be expressed in percentage. Okay, so multiply by 100%. All right, so that will give you the percentage of the return. So please, you don't use absolute value for return under portfolio. You don't use absolute value. It has to be in percentage. So if you are given the absolute value, you use this formula to convert it to percentage. So that's what I have for you. At this point, we can have illustration. Okay, let's have illustration. Let me stop sharing this. Before I switch, let me know, do you have any question for me, please? Okay, so let's move on. Now, I want to give it an assignment. You are going to form a note. All right, you are going to form a note on indifference curve. All right, you form a note on indifference curve. Okay. Examiner can ask you to explain a difference curve. Then number two, you form a note on security market line. Security market line. You also form a note, number three, on capital market line. Okay, capital market line. Then number four, capital allocation line. Capital allocation line. So wherever examiner is coming to you, they are very straightforward and interesting, just the same way I explained as the efficient frontier. So of course, each of them has to do with a graph, all right? So just the way I explained the efficient frontier, so same way you are going to do for each of them, all right? Please ensure you do it. So, and then for those of you that have the golden book, there are more detailed information on the portfolio. Please ensure you go through them one after the other. So let's have illustration. If I'm able to solve two illustration, I mean, we are fine. Yes, let's start with illustration number two. Illustration number two. Who is helping us to read? Somebody should help us. Yes, quickly. Who is helping us to read? Yeah. Who will help us?
You are considering investment in one
Thank you.
or both. You are considering investment in one or both of two securities, X and Y, and you're giving the following information: tabular form, security, possible rate of return, probability of occurrence. You are required to A. Calculate the expected return for each security separately and for a portfolio comprising 60% of X and 40% of Y, assuming positive correlation between the possible rates of return from the shares comprising the portfolio. B. Calculate the expected risks of each security separately and of the portfolio as defined above. For this purpose, the measure of risk may be taken as a standard deviation of probable variances from the expected rate of return. C. Outline the objectives of portfolio diversification and explain in general terms why the risks on individual securities may differ from that of the portfolio as a whole.
Thank you. Yes, that is the question. Examiner is asking you in the A part of the requirement to calculate the expected return for each security separately and for the portfolio comprising 60% of X and 40% of Y, assuming a positive correlation between the two, between the possible rate of return from the shares comprising the portfolio. Now, let me stop sharing this and move to the working notes quickly. Okay. Solution. Solution to illustration 2. Page. What page is that? That should be page 85. Page 85. Okay. So let's move on. The name of the investor we're not given. So now you can see from the question that your possible rate of return is given to you in percentage. So no worries, no additional information. I mean, no additional effort is required to convert it. So since it's already in percentage. However, in the requirement A, you have to calculate expected return of each security and also for the portfolio. So I would then say calculating number A1, calculating expected return of individual security. So how do you do this? Very simple. We said that because examiner has also asked you in B part of the question that you should calculate the risk of the portfolio, the risk of individual security and of the portfolio. So we are going to use one table to achieve everything. So I will then say security X. You do it separately. So whenever you want to calculate, let me write it out. Whenever you want to calculate the risk of individual security, the risk of security X will be calculated as summation of probability of X. Okay, so that's the expected return of security X. Of course, it's the same formula for Y. So in this case, I will then say, of course, also, if you want to calculate the risk of individual security, you need to get the square root of variance. So what am I saying? This is expected return of security X. Then the risk of security X will be computed as the variance summation of probability of X minus X bar square. So we are using you are going to square the it's too close. Let me write it. Which is the square root of variance summation of P of X minus X bar square. So now we are going to use a table to do all our workings. So you do it for security by security. So this is for security X. Okay. So from this formula, which is expected value, all right. So you multiply probability with the return of security X. Therefore, you create a column for probability, you create a column for return, then you have expected return. Okay, you have expected return or expected value. Let's call it expected value. Then because we want to calculate standard deviation as well, so we need to just extend the table once and for all. So we are going to create a column for X minus X bar square, then probability of X minus X bar square. Okay. So of course, this is P, this is X. Okay. For security X, we go back to the question, what's the probability of security X? For security S, probability is 0.3, 0.4, and then 0.3. 0.3, 0.4, 0.3. At all time, your probability must be equal to 1. If your probability is not equal to 1, you need to make it equal to 1 and state your assumption. Then the return of security X, according to the question, is 30, 25, 20. 30, 25, 20. Okay. Let me confirm that. Yes, correct. So to get the expected value, you are supposed to multiply the probability with the return. You multiply the probability with the return. That will give you the expected value. Okay. Let me withdraw this. So this will be the return of security X. So 0.3 of 30, what do you have? Please, I need you to give me the numbers. 0.3 multiplied by
9, 10, 6.
9, 10, 6. When you add it up, that will be 25. So the expected return of security X is 25. Now, because in B part of the question, you also have to compute the standard deviation, which is the risk of individual security and of the portfolio. So we need to extend the table using this formula here. This is the formula we have expanded. So in this case, X of 30 minus 25 will give us 5. 5 squared will give us 25. 5 squared will give us 25. 25 multiplied by 3, what do you have? Multiply that with probability. 25 multiplied by 0.3, what do you have?
7.5.
7.5. Then 25 minus 25 will give us 0. 20 minus 25 will give us minus 5. Minus 5 squared will give us 25. 25 multiplied by 0.3 will give us 7.5. When you add it up, the variance of security X is 15. That's the variance of security X. All right, I'll do the same thing for security Y.
Sorry, sir, please, I didn't get the calculation.
Pardon?
I didn't get the calculation for variance.
This is the formula we are using. This is the formula here. X minus X bar. This is X minus S bar squared. So you are multiplying probability. P is the probability. You are multiplying probability with this 25. 0.3 multiplied by 25 will give you 7.5. That's how we did for the third one too. 0.3 multiplied by 25 will give you 7.5. You add it up. Is it clear now?
Yes, sir. Thank you.
All right then. So you do for security Y. Okay. So probability return. Of course, this is P, this is Y, then this is expected value, Y minus Y bar, Y minus Y bar square, then probability of Y minus Y bar square. So I will then go back to the question, what's the probability of security Y? 0.2, 0.6, 0.2, 0.2, 0.6, 0.2. Here is 1. Okay. This is the expected return on security Y. Give me the return of security Y, please.
50, 30, 10.
50, 30, 10. So 0.2 multiplied by 50 will give us 10.
10, 18, 2.
10, 18, then 2. When you add it up, this is 30. Expected return on security Y is 30. Therefore, we need to calculate variance of security Y. Variance of security Y. So 50 minus 30, this 50 here, minus 30 will give us 20. 20 square, you square the 20, that will give us 400. 400 multiplied by probability of 0.2 will give us 80. The next one, 30 minus 30 will give us 0. Then 10 minus 30 will give us minus 20. Minus 20 square will give us 400. 400 multiplied by 0.2 will give us 80. When you add it up, that's 160. Okay, now that we have calculated variance and expected value of individual security, so we can then go back to answer the question. So the first one says we should calculate the expected return of individual security and of the portfolio. So in this case, I don't need to waste time. Let me even remove this. Let me remove this. Calculating expected, oh, I did not put return. Expected return. Expected return and variance. Okay, so that will help us to answer the question clearly. So I can then answer the requirements number A1, expected return. Expected return of individual security. So for security A, security X, we calculated expected return of security X to be 25. For security Y, expected return is 30. Is it 30? Yes, 30. Then for A high, expected return of the portfolio. Simply say portfolio return. RP. So portfolio return is calculated as the proportion invested on security X multiplied by expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. So return of the portfolio will then be equal to, we're investing 60% according to the question. We're investing 60% on security X. That's the proportion, 0.60. Multiplied by expected return on security X is 25. Plus, we invest 40% on security Y. Expected return on security Y is 30. So give me from the left, what do you have? 0.6 multiplied by 25. What do you have? Yes?
15.
15. Plus 12 will give us 27. So the return of the portfolio is 27. This is how to calculate the return of the portfolio. Now, number B, B1, you have to calculate the risk of individual security. Risk of individual security, which is measured by standard deviation. We've not calculated that. So standard deviation, this is the formula for the standard deviation that you have here. So I will just put it here. Standard deviation of X will then be equal to square root of the variance, which is square root of 15 is what? What's square root of 15? Yes.
3.873.
3.87. Okay. So the risk of security X is 3.87. Therefore, the risk of security Y is equal to square root of 160. What do you have there?
12.65.
12.65. That's the risk of individual security. I will then come here. Risk of individual security for X. Risk of X, risk of Y equal to, for X, we have 3.87, I think. I will confirm. Yes, 3.87. Then 12.65. So that's it. Then the second part of the B requirements, you have to calculate the risk of the portfolio. So I can then say portfolio risk. Denoted as DP. So we can use formula since examiner is not specific. So you are not sure whether to use general formulae or to use tabular method. So you are free to use any one. So using I'm going to demonstrate the two for you just in case. So using the general formulae, the risk of the portfolio will be computed as the square root of amount invested on X square variance of X plus proportion invested on Y square it variance of Y plus 2 multiplied by proportion invested on X standard deviation of X multiplied by proportion invested on Y standard deviation of Y multiplied by correlation coefficient between X and Y. So that's the formula. Therefore, the risk of the portfolio will then be equal to, we're investing 60% on X. So 0.60 squared multiplied by the variance of X. Variance of X is 15. We got 15 here. Okay. Here is 15 plus 40% is invested on Y. We square it, multiply by the variance of Y, which is 160. All right. Plus 2 multiplied by proportion invested on X, 60%, multiplied by the standard deviation of X, 3.87. We calculated standard deviation as this. That's the standard deviation of X, multiplied by proportion invested on Y, which is 40%. Standard deviation of Y is 12.65. Okay, 12.65. Then correlation coefficient is equal to 0. Okay, correlation coefficient. You know, I told you that when the probability between the two securities are different, it means that there is no relationship between the security. Therefore, your R is equal to 0. So that's that. There is no need for you to calculate the correlation coefficient since it is equal to 0. So 0.6 squared multiplied by 15. What do you have? Wumi? 0.6 squared multiplied by 15. Give it to me.
5.4.
No rounding. Full number, no rounding. 5 points, 0 points,
5.4.
5.4. Okay. 5.4 plus 0.4 square multiplied by 160.
25.6.
25.6. 25.6. Okay. Then, of course, you know that when you multiply the other part of the formula, when you multiply them with 0, it will give you 0, isn't it?
Yeah.
So plus 0, because when you multiply all of this, it will give you 0. It will be equal to 0 because 2 multiplied by 0.6, all of that multiplied by 0 will give you 0. Therefore, the square root, this should then be square root of, that should be 31. So what's square root of 31?
5.57.
5.57. 5.57. This is the risk of the portfolio. This is how to calculate the risk of the portfolio using formula. So if I want to use tabular method to calculate the return of the portfolio as well as the risk of the portfolio, let me demonstrate how to do that so that in case examiner is specific, so that you know what to do. And at the same time, you are at liberty to either use the formula method or you want to use the tabular method. So alternative solution. Alternatively, using tabular method. Okay, using tabular method, how do you do this? Now, whenever you want to calculate the return of the portfolio as well as the risk of the portfolio using tabular method, depending on the securities you have in the portfolio. In this situation, we have security X and Y. Therefore, you are going to represent the two securities as one letter, all right? But because you want to have combined results. Therefore, you then say let securities X and Y equal to, let's use any letter. We can use A equal to A. You can use M, you can use P, you can use O, you can use Z, any letter you like. So in this case, you are going to bring out the probability of X, of security X is 3. Probability of security Y is also 3. Let me show you so that you know what I'm talking, so that it will be clearer to you. When you look at from the question, probability of X, let me write it out. This is for return, then probability. Okay, this is for X, this is for Y, this is for X, this is for Y. Now, the return of X, give it to me, 30, Wumi, 30, return of X.
30, 25, 20.
30, 25, 30. Then return of Y.
50, 30, 10.
50, 30, then 10. Probability of X.
0.3, 0.4, 0.3.
Okay. Then probability of Y.
0.2, 0.6, 0.2.
Okay, thank you.
Oh,
Now,
return on X is 20, last one, not 30.
of X. Oh, okay. Thank you. Now, so
the probability for Y is that 40, 0.2.
so it's supposed to be
Last one.
0.2. Yeah, thank you. So the reason why I have to write this one out is I want it to be clearer to you. You don't have to do this on the day of your exam. You don't have to do this. I just want it to be clearer to you so that you see what I'm doing. Now, when you want to determine the return of the portfolio as well as the risk of the portfolio using tabular method, the possible outcome you are going to have will depend on the state of nature of each of the securities. Probability is usually attached to the state of nature. In this situation, probability of security X is 3. Probability of security Y is also 3. Therefore, 3 multiplied by 3 will give you 9 possible outcomes. 9 possible outcomes. If, for example, we have X and Y, let's say, for example, probability of security X is 0.5, 0.2, sorry, 0.5 and 0.2, then 0.3. Let's say probability of security Y is 0.6, then 0.4. In this case, probability of X is 3, probability of Y is in 2. When you multiply the 2, it will give you 6 possible outcomes. That's how you are going to determine your possible outcomes. But as far as this question is concerned, we have 9 possible outcomes. Therefore, you are going to keep the return of one security constant, and you vary the return of other securities. You will see what I'm talking about later on. Let me see if this one can accommodate 9. 1, 2, 3, 4, 5, 6, 7, 8. So no, let me go to the next page. So in this case, you can say possible outcomes. Possible outcomes. Then you create another column for workings. Working for return. Then we are going to have the return. You have return. Then we have expected. We have probability. We have expected return or expected value. Then you are going to have A minus A bar. Remember, we have said that let security X and Y equal to A. So we're going to have A minus A bar, A minus A bar squared. Then we are going to have probability of A minus A bar. I think maybe I should reduce the font of my handwriting so that I don't want it to cut. Let me reduce it so that I can accommodate. Return working for return. We have the return. Then we have probability. We have expected value. We have A minus A bar, A minus A bar squared. Then probability of A minus A bar squared. Better. Okay. So 1, 2, 3, 4, 5, 6, 7, 8, 9 possible outcomes. All right. Let me see. Let me complete the table. So whether you use the tabular method or you use the formula, you are expected to get the same answer. Okay. That's the return of the portfolio. A bar. So you will see from here, we are going to be combining the return of each security. So that's essence of writing this out. So follow the way I'll be doing it. From the first return of 50, so of 30 for X. So the proportion we are invested in security is 60%. Therefore, 0.60 multiplied by 30 plus 0.40 multiplied by the return of security Y is 50 multiplied by 50. So remember what I said, you are going to keep return of the first of one security constant, then you vary the return of other security. So move to the second one. Here will be 0.6 multiplied by 30. We are keeping return of X. We are keeping it constant plus 0.4 multiplied by, what's the next return for Y? 30. Here is 30. Let me write that. Then 0.60 multiplied by 30 plus 0.40 multiplied by, I think the next one is 20, 10 multiplied by 10. So I've completed the first cycle. I'll move to the next one. 0.60 multiplied by the next return for X is 25. So 0.60 multiplied by 25 plus 0.40 multiplied by 30. 0.60 multiplied by 25
Should that be 30 or
plus,
50?
pardon?
The last one you wrote,
Yeah.
is 0.4 times 50. That number
Which
4.
one? You mean this?
Yeah, the number
0.4 multiplied by 30.
Okay, so we are
Oh,
leaving
so it's
50.
supposed to be 50. It's 50. It's supposed to be 50, not 30.
Okay.
Multiplied by 50. Thank you. Oh, I even wrote 50 there before, but it looks like 30. Multiplied by 50. Better. So 0.4 multiplied by 30. Again, 0.60 multiplied by 25 plus 0.40 multiplied by 10. Then the third cycle, 0.60 multiplied by the return, the
20.
third return, 20 multiplied by 20, 0 multiplied by 50. 0.60 multiplied by 20 plus 0.40 multiplied by 30. And the last one, 0.60 multiplied by 20 plus 0.40 multiplied by 10. So that's how you are going to do your combination. So multiply for me. Give me the return. This is A. This is P. Yes?
Hello, sir. Hello.
Yes?
Why are we using only 0.6 and 0.4? Sorry, I'm confused.
Why am I using 0.6, 0.4? So don't you see 0.6 and 0.4 in the question? I mean, what else do you want us to use? Talk to me. What do you want us to use? What do you think we should use?
We have three probabilities now. We have for the first line 0.3 and 0.2, 0.4, 0.6, 0.3, 0.2.
Are we using probability? Because I'm not getting you, Ufoma. Look at the heading. Ufoma, are you listening to me?
Yes, sir.
Look at the heading of what we are doing, working for return. We are less concerned with probability here. We are doing for return first. So to get your combined return, you are supposed to multiply the weight of individual return with the return. So the weight of security X, you multiply the weight of individual security with the return of the security. So the weight of security X is 60%, weight of security Y is 40%. So you multiply the weight by the return of individual.
Okay, yeah, I understand now. I understand. So we are multiplying with the weights.
Yes.
Thank you, sir.
So what do you have as the return? 0.6 multiplied by 30 will give you 18. 0.4 multiplied by 50 will give you 20. That's 38.
38.
30, 30,
Yeah.
22,
30.
20, 22,
32.
22.
22. Okay. Yes. 0.62, 0.6 multiplied by 25 plus
35.
35. Okay. Yeah. Next one. 0.6 multiplied by 25 is what? Then plus 12. Are we still together?
Yes, sir, we are here. 27.
27.
19.
19.
Someone should confirm.
Then 0.6 multiplied by 20 will give us 12. 12 plus 20 will give us 32. 12 plus 18 will give us 30. 12 plus 4 will give us 16. Please confirm the numbers. Is it confirmed? Are the numbers correct?
32, yes. 32 is correct.
The last one is okay. It's 16.
16. All right then. So let's move on. Now, pay attention, please. The same way you combined the return is the same way you are going to combine the probability. I repeat, the same way you have combined the return to arrive at these numbers that you have here is the same way you are going to combine your probabilities. So you then go to the question.
Row 9 is 24.
24. Okay.
Yes.
0.6 multiplied by 20 will give you 12. 0.4 multiply. Pardon?
Number 8 is number 8 that is 24.
24. 8, 24.
24, okay. Which is 12 plus 12. That's 24. Correct. So this 32, is it correct too?
Yes.
12
Yes, sir.
plus 20. Yeah, okay then. So the same way you combine the return is the same way you are going to combine the probability. So I will then go back to the question. The first return, which is 30, you combine it with return of y of 50. Therefore, 0.3 multiplied by 0.2. Ufoma, I hope you are paying attention. Ufoma?
Yes, sir.
Aha. So 0.3 multiplied by 0.2 will give us 0.06. Here will be 0.06. Again, the line 2, for line 2, this line here, your return is still 30, but the return of x is still 30, but the return of y is also 30. Therefore, probability of that 30 of the first 30 is this 0.3. The probability of the second of this 30 is 0.6. Therefore, 0.3 multiplied by 0.6 will give us 0.18. That's 0.18. 0.18. Again, 0.3 multiplied by probability of that 10 for y. 10 of y, this is 10 of y. Probability of that 10 is 20. So you are multiplying this 30, this 0.3 multiplied by 0.2 will give us a 0.06. So move to the next one. The probability of this 60, the probability of the 60, of this, sorry, of the 25, probability of 25 is 0.4. So what that simply means is that you are supposed to multiply this 30. For example, you multiply this 30 with all the probability of y. You multiply 0.4 with all the probability of y. You multiply 0.3 with all the probability of y. That's what you are supposed to do. Therefore, 0.4 multiplied by 0.2 will give us 0.8.
0.08.
0.08. Then again, 0.4 multiplied by 0.6, that's 0.24. 0.24. Then 0.4 multiplied by 0.2 will give us 0.08. Move to the next one. Let me write that to make it bolder. So the next one, which is the last one, you are going to multiply 0.3 with all the probability of security y. Therefore, 0.3 multiplied by 0.2 will give us 0.06. 0.3 multiplied by 0.6, 0.18. Then 0.3 multiplied by 0.2, that's 0.06. So that's what you need to do. At this point, every other thing is straightforward. Therefore, of course, to get the expected value, you are supposed to multiply the probability with the return. Therefore, 38 multiplied by 0.06. What do you have for me? 38 multiplied by 0.06.
2.28.
Pardon?
2.28.
2.28. Okay. Next one.
5.4.
5.4. Next.
1.32.
1.32. Did you say 1.32?
Yes, sir.
Next one.
2.8.
2.8.
6.48.
6.48.
1.52.
1.52.
1.90.
1.92.
Yes, sir.
Let me write it. What's wrong with you? Next one,
4.32.
4.32. And the last one,
0.96.
0.96. Add it up. Yep.
27.
27. 27. So you see that when we use formula to calculate the return of the portfolio, we also got the same thing as 27. So whether you use formula or you use the tabular method, you're expected to get the same answer. So to now calculate the risk of the portfolio, of course, we need to expand the table. Therefore, 27 is the A bar. The figures you have under the return, they are that is A. Therefore, 38 minus 27, that will give us 11. 11 squared will give us 121. 121 multiplied by probability of 0.06. What do you have? Yes. Pardon?
7.26.
No rounding. 0.26. No rounding. Write it out in full. Next one. 30 minus 27 will give us 3. 3 squared will give us 9. 9 multiplied by 0.18. What do you have?
1.62.
1.62. 1.62. Next one. 22 minus 27 will give us minus 5. Minus 5 squared will give us 25. 25 multiplied by 0.06. What do you have?
1.5.
1.5. Next one. 35 minus 27 will give us 8. 8 squared will give us 64. 64 multiplied by 0.08. What do you have?
5.12.
5.12. Next one. 27 minus 27 will give us 0. 19 minus 27 will give us 8. 8 squared will give us 64. 64 multiplied by 0.08 will give us 5.12. We've done it before. 32 minus 27 will give us 5. 5 squared is 25. 25 multiplied by 0.06 will give us 1.50. 24 minus 27 will give us minus 3. Minus 3 squared is 9. 9 multiplied by 0.18 will give us 1.62. Then 16 minus 27 will give us minus 11. Minus 11 squared will give us 121 multiplied by 0.06 will give us 7.26. Add it up. What do you have? Add up the variance of the portfolio. What do you have?
31.
31. Thank you. So what's square root of 31?
5.57.
Okay, so the risk of the portfolio is equal to the square root of the variance of 31, which is equal to 5.57. Okay, so which is the same thing, I think, which, yes. So it's the same thing as this when we use formula. So that's to show you that whether you use tabular method or you use the formula, you are expected to get the same answer. You can imagine the level of stress we have gone through using the tabular method. Please, of course, I don't expect you to be using the tabular method on the day of the exam if you are not asked to use it, but you just have to master it because you never can tell. Examiner may be specific and ask you to use the tabular method. Then in that case, you have no choice than to use the tabular method. Please, watch out. This is not part of our calculation. I use this one on the day of your exam. You don't need to be doing this. All right. I only do this to demonstrate. All right. So that is the end of the question. So I have one more illustration for you. So, but what I'm going to do in this case, I'm going to use, because of time, I'm going to use a prepared solution to explain it so that you see what I'm talking about. Okay, so let me know if you have any question for me before I switch. If there is no further question, then let me stop sharing this and move to the another illustration.
Alexa,
Yes, talk to me.
so this formula, the one with the
Yeah.
square root, are we expected to cram it or it will be at the back of the question?
You can see, Wumi, I laughed in Latin. I can imagine. No, you have to memorize it. Examiner will never give it to you. You have to memorize. No worry, it's very straightforward. By the time you listen to the video, you see the way I'm calling it out. So it's straightforward. All right. Okay, then. So let's have one more illustration. Let's have this illustration number 3. This illustration, you see that you notice that the return given to you for each securities is in absolute number. And you don't use absolute number. You need to convert it to percentage. Well, that's why I'm particular about solving this. So let's go through the question together. Who will help us to read, please? Quickly. Who is helping us to read? Let me see. Let me run through the Pascal has disappeared. Okay. Somebody should help us to read, please. Yes.
Johnson.
Okay, thank you.
Johnson has just won 100,000 naira from Baba Ijebu Lottery Limited and has decided for the interim to place the money on 2 securities, X and Y, for a period of 1 year. 60,000 naira is to be placed on security X and the balance on security Y. He has estimated returns, that is cash flows to be received at the end of the year, plus project value at that time, and the probabilities of the 3 possible states are as follows. Required: A. Calculate the expected return, variance or standard deviation of each security. B. Calculate the covariance between the 2 securities and the correlation coefficient. C. What are returns of its portfolio for each of the possible states A, B, and C. Calculate the expected return variance and standard deviation of the portfolio from these figures. D. Using the general formula for the mean return and variance of a 2-security portfolio, recompute the mean return, variance and standard deviation of its portfolio. E. Would your answer to D above be different if the correlation coefficient had been plus, that's +1, +0.5, 0, or -1? What conclusion do you draw?
Thank you, Diamond. That is the question. In the A part, you are expected to calculate the return, variance, and the standard deviation of each security. Okay, that's very straightforward. Then number B, calculate the covariance. Of course, when you look at this question, you will notice that both security X and Y have the same probability. Okay, both security X and Y have the same probability. Oh, my pen has stopped again. So both security X and Y have the same probability of 0.3. Let me see. My pen. Okay. Let me just. So now what we need to do, you notice that because they have the same probability, it means that there's a relationship between security X and Y. And that's why the examiner is asking you in the B part of the question to calculate covariance and the correlation coefficient. So whether you are told that or not is something you must do. Then requirement number C and D are the same. Requirement number C and D are the same, in that you are expected to calculate the return of the portfolio. Okay, you are expected to calculate the return of the portfolio, the standard and the variance, and the risk of the portfolio. Number D also, you do the same thing. You are expected to calculate the return of the portfolio and the standard deviation of the portfolio or the risk of the portfolio. However, in the D part of the question, examiner was specific. You are told to use the general formulae. So since you are told to use the general formulae, it means that the C part of the C requirement, you are supposed to use the tabular method for that C. So that's just the difference between the two. Number C, you will use the tabular method, but number D, you are supposed to use the general formulae to get the same answer. So that's what we want to do. Quickly, let's go through it together. I will stop sharing this and move to the solution. My pen has stopped working again. So the first thing you need to do is to go and calculate since the return given to you in the question is in absolute figure. So all you need to do is to go and do your working first. Convert the absolute value of your return to the percentage. That's the first thing you need to do. And that's what you have done here. That's what you have here. So in the workings, when returns, I've already explained to you earlier today, when return is given in absolute value, as shown in this question, it should be converted to percentage as follows. So value at the end minus value at the beginning over value at the beginning will give you the return in percentage. So for security X, you are going to do it state by state. The state of nature A for security X. The value at the end, let me go back to the question. So we are told that predicted return at the end of the year. So all the value you have in the table, they are the value at the end. The value at the beginning is the amount you have invested on the investment. 60,000 is invested on security X. So the balance of 40,000 is on the security Y. Therefore, 75,000 minus 60,000 divided by 60,000 multiplied by 100% will give us the percentage of return for state A for security X. All right. So 75,000 minus 60,000 over 60,000 will give us 25%. For state B, the return at the end, value at the end is 73,200 minus 60,000 divided by 60,000. That's 22%. For state C, value at the end is 67,200 minus value at the beginning, 60,000 over value at the beginning is 60,000. We have 12%. So that's the working for return for security X. You do the same thing for security Y. We are investing 40,000 naira on security Y. value at the end for state A is 45,600 minus 40,000 over 40,000. We have 14%. For state B, 47,200 minus 40,000 over 40,000 will give us 18%. For state C, value at the end of 48,000 minus value at the beginning of 40,000 over 40,000 will give us 20%. So now that we have converted the return in absolute value to percentage, we can then proceed to calculating the expected return of individual security, the risk of individual security, expected return of the portfolio, and the risk of the portfolio. All right. So examiner is asking us in the A part of the question that we should calculate the expected return, variance, and standard deviation of each security. So you do for security X first. So the probability is 0.3, 0.45, and then 0.2. Please, at all times, your probability must be equal to 1. If it is not equal to 1, you need to make it equal to 1. So the return we have computed for X is 25, 22, and then 12. So to get the expected return, so 0.3 multiplied by 25 will give us 7.5. 0.45 multiplied by 22 will give us 9.9. 0.25 multiplied by 12 will give us 3. When you add it up, that's 20.4. To now get the variance of security X, we need to expand the table. So X minus X bar. X is the return. X bar is 20.4. Therefore, 25 minus 20.4 will give us 4.6. 4.6 squared will give us 21.16. 21.16 multiplied by probability of 0.3 will give us 6.348. So the next one, 22 minus 20.4 will give us 1.6. 1.6 squared will give us 2.56. 2.56 multiplied by probability of 0.45. We have 1.152. The third one, 12 minus 20.4 will give us minus 8.4. Minus 8.4 squared will give us 70.56. 70.56 multiplied by probability of 0.25 will give us 17.64. So you add up the variance together, add up the value together, we have 25.14. So the variance of security X is 25.14. So to calculate the risk of security X, then it will be square root of the variance of 25.14, and we have 5.01. So you do the same thing for security Y. For security Y, probability remains the same, but expected return in percentage you have computed is 14, 18, then 20. So to now get the expected return, 0.3 multiplied by 14 will give us 4.2. 0.45 multiplied by 18 will give us 8.1. 0.25 multiplied by 20 will give us 5. We add it up, we have 17.13. So to now get the variance of security Y, 14 minus 17.3 will give us minus 3.3. Minus 3.3 squared will give us 10.89. 10.89 multiplied by 0.3 will give us 3.267. The next one, 18 minus 17.3 will give us 0.7. 0.7 squared will give us 0.49. 0.49 multiplied by probability of 0.45 will give us 0.2205. And the last one, 20 minus 17.3 will give us 2.7. 2.7 squared will give us 7.29. 7.29 multiplied by probability of 0.25 will give us 1.8225. So you add up everything. The variance of security Y is 5.31. Then to now get the standard deviation of security Y, this one's supposed to be Y, not X. So standard deviation of security Y, so that will be square root of 5.31 will give us 2.3. So that answers the first requirement of the question, which says that we should calculate the expected return, variance, and standard deviation of each security. So that's what we have done so far. Then number B of the question, you are expected to calculate the covariance of the two securities and the correlation coefficient. Will you recall what I told you earlier today? Covariance measures the linear relationship between two variables. All right, so you want to measure the linear relationship between security X and Y. So, of course, there is no way you can get the correlation coefficient between X and Y without getting the covariance, and that's what the examiner is asking you to calculate covariance first. So how do you then calculate the covariance? Covariance between the two security will be computed. Let me see if I have the, okay. So to calculate the covariance, correlation coefficients, and covariance, first thing first, of course, the covariance is computed by multiplying probability with the difference between the return and the expected return of each security. So this is the formula for calculating covariance as demonstrated for you earlier today. Therefore, I will then go to my calculation in A above. X minus X bar. Here is X minus X bar. All the figures I have under X minus X bar, I will create a column for it. That is it here. All right. I will also do the same thing for Y minus Y bar. All the figures I have under Y minus Y bar, I bring them out. That's what you have here as well. Therefore, probability of the two securities are the same. Therefore, line by line, you multiply it together. 0.3 multiplied by 4.6 multiplied by minus 3.3 will give us minus 4.554. 0.45 multiplied by 1.6 multiplied by 0.7 will give us 0.504. The third one, 0.25 multiplied by minus 0.84 multiplied by 2.7 will give us minus 5.67. When you add everything together, we have a total of minus 9.72. So covariance between security X and Y is equal to minus 9.72. So to now get the correlation coefficient, which measures the relationship between security X and Y, this is the formula we are supposed to use. Correlation coefficient is computed as covariance between security X and Y divided by standard deviation of X multiplied by standard deviation of Y. So we have computed covariance between security X and Y to be 9.72. All right. Then you divide it by the standard deviation of X. We computed standard deviation of X to be 5.01. Standard deviation of Y to be 2.3. So you multiply the two together and we have minus 9.72 divided by 11.523. Then the correlation coefficient between security X and Y is minus 0.84. So when your correlation coefficient is exactly is 50, when the correlation coefficient is 50, either positive 50, minus 0.5 or negative 0.5, then you say the relationship between the security is highly, is averagely 50%, that is 0.5, whether it is positively or negatively 50. Now, if it is more than 50, like in this case, minus 0.84, so it means that once it is more than 50, then you can say the relationship between the security is negatively or positively highly correlated. Once it is more than 50%, it is highly positively or negatively correlated. But if it is low, if it's less than 50, you can say it is lowly positively or negatively correlated. So you must know how to interpret your result. So like in this case, our correlation coefficient is minus 0.84. So it means that the correlation coefficient of 0.84 which measures the relationship between X and Y, is highly negatively correlated. Okay, so that is the interpretation of that. Then number C part of the question, you have to calculate the return of the portfolio and the risk of the portfolio. So like I said, the C and the D part of the question is the same thing, only that in the D part, you are supposed to use the general formula. So which means that in the C, you have to use the tabular method. And because using the tabular method, because the two securities have the same probability. So you're only going to have 3 possible outcomes. That is 3 multiplied by 1. So that will give you 3 possible outcomes. And that is what I have done here. To answer the number C question of the number C requirement of the question using tabular method. So you can say let X and Y equal to A. So because we have the same probability for the two securities, so 3 multiplied by 1, that will give you 3 possible outcomes. So that's why you're having this state 1, 2, A, B, C, A, B, and C. So you pick the proportion of security X, you multiply with the return of security X. Proportion of security Y, you multiply with the return of security Y. In this case, there is no need for you to keep one return constant and vary the other because they have the same probability. So it is only when they have different probability that you keep one of the return constant, you vary the other. So, but in this case, you don't need to do that. All right. So, and we got 20.4, 20.6, 20.4, then 15.2. All right. Then the same way we have combined the return is the same way you are going to combine the probability. But because they have the same probability, so just repeat the probability you have, 0.3, 0.45, and then 0.25. Okay? Then you find the expected return. 20.6 multiplied by 0.3 will give us 6.18. 20.4 multiplied by 0.45 will give us 9.18. 15.2 multiplied by 0.25 will give us 3.8. When you add it together, it will give us return of the portfolio is 19.16. To now get the risk of the portfolio, you must first of all determine the variance of the portfolio. Therefore, to get the variance of the portfolio, you are going to less the return of 20.6, you less 19.16. We have 1.14. 1.14 square will give us 2.0736. 2.0736 multiplied by probability of 0.3 will give us 0.62208. The next one, 20.4 minus 19.16 will give us 1.24. 1.24 square will give us 1.5376. 1.5376 multiplied by a probability of 0.45. We have 0.69192. The last one, 15.2 multiplied by 19.16 will give us minus 3.96. Minus 3.96 squared will give us 15.6816. Multiplied by probability of 0.25, we have 3.9204. When you add it together, we have the variance of the portfolio to be 5.2344. To now get the risk of the portfolio, just find the square root of the variance of 5.2344. We have 2.29. That is what you are going to do to answer the C requirement. Then for requirement number D, you have to calculate the return of the portfolio as well as the risk of the portfolio using the general formula. Using the general formula to calculate the return, of course, you are aware the return of the portfolio is the weight, the proportion invested on security X multiplied by expected return on security X plus proportion invested on security Y multiplied by expected return on security Y. We have invested 60,000 out of 100,000 naira. We have invested 60,000 naira on security X. 60,000 over 100 will give us 60%. We invested 40,000 naira on security Y. 40,000 divided by 100 will give us 0.4. Therefore, 0.6 multiplied by 20.4 20.4 is the expected return we calculated for security X. This is the 20.4. Security Y, we calculated expected return of 17.3. So this will give us 12.24. Then 4.4 multiplied by 17.3 will give us 6.92. When you add it together, we have 19.16, which is the same thing as expected return using the tabular method. Okay. Then we also have to calculate the risk of the portfolio. In this case, we are using the formula. We want to use the formula to do that. Okay, so we're investing 60% on security X. You square it. Variance of security X is 25.14. We got 25.14. This is the variance of security X. Variance of security Y is 5.31. Okay. This is the 5.31. So, of course, we're investing 40% on Y. We square it. Then, weights, we're investing 60% on X multiplied by standard deviation of X. We invested 40% on Y multiplied by standard deviation of Y. The correlation coefficient between X and Y, we calculated minus 0.84. That's the correlation coefficient we got here, minus 0.84. Okay, then of course, put everything in the formula. We have the risk of the portfolio to be 2.29, which is consistent with using the tabular method. So it's the same answer we got. All right. So that is basically that. That's what is expected to do using the tabular, using the general formula. Now, in the number E requirements, for the E requirements, examiner is asking you, would your answer to D above be different if the correlation coefficient had been +1, +0.5, 0, or -1? So what you are supposed to do in this case is to be changing your correlation coefficients. All right, you are going to be changing the this correlation coefficient. Instead of -0.84, examiner is asking you, what will be your results if you use +1, if you use +0.5, if you use 0 or -1? So in this case, on the day of your exam, if you are faced with this kind of a situation, first thing you are going to do when you are doing your calculation, since you know that to answer the number E requirement, the only thing that will be changing is your correlation coefficient, your R. So in this case, you are supposed to multiply all of these two together. So you keep it on one side, and that is what I've done here. That is what I've done here. When you look at this, that is what I've done here, because I know in the E part, I'm going to need it. So in this E now, because this 9.9 still remains the same, it will not change. All right, the 9.9 will not change. What will be changing is this correlation coefficients, minus 0.84. So examiner say we should assume 0.1. So if we assume 0.1, then it will be square root of 9.9 plus 5.53104 multiplied by 1. The positive one you are seeing here is this one. Therefore, when you put it in the formula, the risk of the portfolio when correlation coefficient is +1 is 3.93. The next one, we are told that if correlation coefficient is +0.5, so in this case, this one will change also to +0.5. So +0.5 multiplied by 5.53104 will give us 2.76552, then plus 9.9. We have a square root of 12.66552, which gives us the risk of the portfolio to be 3.56. You do the same thing for 0 when R is equal to 0. So if R is equal to 0, it means that whatever you have here, everything will be equal to 0. Therefore, square root of 9.9 will give us 3.15. Then the last one is minus when R is minus 1. So if R is -1, then in this case, Of course, it will now be 5.53, 104 multiplied by -1. It will give us minus 55.31104. So, of course, plus 1 will now give us 4.36896. Find the square root, we have 2.09. One thing examiner is now asking you, what conclusion do you draw? You will notice that when the correlation coefficient is perfect 1, perfect positive 1, the risk of the portfolio is higher at 3.93. But when it is -1, okay, when R is -1, the risk of the portfolio has reduced to 2.09. Therefore, it can be concluded that from the calculation above, that the lower the correlation coefficient, or the lower the covariance or correlation coefficient between the two securities, the lower the portfolio risk, and then the vice versa. So that's basically what examiner is asking you to do there. And that's end of the question. Let me know if you have any question for me. Any question so that we can close the class? Some of you have disappeared. Good. Any question for
I
me?
have a question, sir.
Pardon?
I have a question.
Talk to me.
So you said if the probability is not 1, we should make it 1. So how do we
Yeah.
do that?
So, for example, like I said, if probability is not equal to 1, you have to make it equal to 1. What do I mean by that? Say, for example, you are given this probability of 0.5, 0.2, and 0.25. When you add it up, that will give you about 0.95, which is not equal to 1. So what you can do is that you can make any of the probability, the balance of 0.5, you can give it to either the first one or the last one. So for example, you can say 0.5, 0.2, then 0.3. Then you now state your assumption that, note, the probability given above is 0.95 instead of 1. Therefore, it is assumed that the last probability is 0.3 instead of 0.25. That's all. So you just have to state you make it equal to 1, then you state your assumption. Move on from there. Yeah. It may be a typo. It may be a typo when the question was being developed. Yeah. So any other question? Uferman is still on. Diamond has disappeared.
What the draft now? The graph to say we should draw is using the covariance and the
The
return.
graph. Which graph? Uferman, which graph?
The question says we should draw a graph.
I didn't get that. Your line is breaking. Talk to me clearly. What are you saying, Uferman? Uferman,
Okay,
talk to me.
I've seen it. What conclusion do you draw? I thought it's a graph that they say we should draw.
Oh. Okay then. Yes. In the absence of no further question, this is what we are going to call it a day. By the grace of God, in our next class when we meet, we are going to be doing capital Z pricing model. We may likely meet either Friday or Saturday so that we can cover the outstanding topic that we have. Okay, so thank you guys for your time and patience. I will see you next time by the grace of God. Bye-bye, everyone.
Thank you,
Thank you,
sir.
sir. Good night.
Good night. Bye-bye.